Thank you again for tuning in to the Constructive House channel. And here we're going over the Mortgage Word Guide Part 3. Again, you can purchase this on Amazon.com for just $5. I do hope that you find this information valuable and constructive, as this is the Constructive House channel. But getting into Part 3, I did want to go ahead and start with conforming mortgage loans. All right, a conforming mortgage loan is just a type of loan that follows specific rules and guidelines by Fannie Mae and Freddie Mac, and it allows you as a consumer to know that, hey, my bank is giving me this loan from the bank, and it does conform with Fannie Mae or Freddie Mac's guidelines. So you do know that this loan is being regulated. So a conforming loan is not a government-backed loan. It's not a FHA. It's not a VA or a USDA loan. It is a Fannie Mae or Freddie Mac regulated loan. Those are not government agencies. However, they are sponsored by the government. But they set the rules and regulations to ensure that the banks aren't just giving you any loan that they feel will allow them to grow their portfolio. They do have to conform with the loans for Fannie Mae and Freddie Mac in order for them to be able to buy the loan off of the secondary market, so the banks are able to lend out more money. So they sell the loans to Fannie Mae or Freddie Mac, and the banks from there use those funds or proceeds to lend out more money. But in order to do that, they do have to conform or fall in line with the guidelines from Fannie Mae or Freddie Mac. Always, always, always ask your mortgage professional if you are getting a conforming loan. They may say it's conventional. Ask them, does it conform with Fannie Mae or Freddie Mac? These are questions you want to make sure you're prepared for and that you do ask a mortgage professional prior to getting pre approved or pre qualified for a mortgage. All right, conventional loan. A conventional loan is a loan that you get directly from the bank. They typically are conforming loans, but they aren't always conforming loans. It's a loan that you get directly from the bank. It does come with its benefits of itself. Some of the benefits do include you can waive your escrow account. So, with a government loan like a VA loan or an FHA loan or even USDA, you have to include your payment for your property taxes and your homeowner's insurance. Well, with a conventional loan, that can be waived. A conventional loan has a lot of leeway because it's a loan you're getting directly from the bank, so they can set the terms and guidelines. Keep in mind, like I mentioned before, most banks are going to give you a conventional loan based on Fannie Mae or Freddie Mac's guidelines. Not always, but in most cases, they're going to do that because, like I stated before, they want to ensure that the loan is available for purchase on the secondary market. That allows them that opportunity to lend more money because they can use the proceeds from that sale to lend more money. But a conventional loan, simply put, is a loan you get directly from the bank. It is not backed by FHA, USDA, or VA. Credit score. Simple enough. I'm sure many of you are familiar with a credit score, but it's just a report card for how well you've been managing your credit. Any types of loans you've taken out, maybe on your credit report, like revolving debt, maybe an auto loan or a furniture account, any credit that has been extended to you by a financial institution or a bank is measured out on a credit score. And that credit score goes from, I believe, 400 to 850. So keep in mind, it is just a measurement. It's a report card, if you will, on how well you're managing your debt, how well you're paying your credit obligations. So it's going to weigh in many factors, how your loan amount versus the limit amount is. If you have any judgments, any collections, those will all be factored in on your credit score. So make sure you are paying your bills on time. If you're able to pay things off in full, do that. But you want to make sure that you're doing a good job managing your credit so you can have a good credit score, which will give you those keys to mortgage success when it comes to getting a loan, because this is a credit transaction. So you do want to make sure you have a good credit score. A great credit score is above 760. A not so great credit score would be like a 400. But make sure you are maintaining your payments, you're staying on top of that. And keep in mind, you do get an annual free credit report from the three major bureaus where you can determine and be able to evaluate where you stand. And the three major bureaus are TransUnion, Equifax, and Experian. All right, debt to income. I'm sure some of you may have heard DTI. They may have said you have good DTI. They may have said that your loan is rejected because of DTI. But DTI is debt to income, and it's your monthly debt divided by your gross monthly income. That's income that you get or earn prior to any taxes or deductions being taken out of your check. All right. So the debt that they're using in a DTI qualification, a DTI ratio, is your monthly debts that are on your credit report. Now, there are some debts that may be included that's not on your credit report, like child support or alimony. Things along those lines may not be on the credit report, or may not be on the credit report. However, they are factored into your debt obligations. What they're not typically looking at is your grocery bill, your power bill, how much you're spending on gas, or your movies or barbershop trips. Those aren't going to be factored into your DTI. But what will be factored in is your monthly payments on that credit report and any other monthly obligations you have that could be court ordered, like a child support payment or any alimony or spousal support payments you have to pay through court order. Those will be included, as well as whatever your new housing payment will be. This helps determine what your ability to repay is, essentially, how much of a loan you can take on. Banks want to evaluate that based on your debt to income. This is a very, very critical piece of your mortgage success. As I always say, there's four C's to mortgage success. That's income, property, assets, and credit. And the income part is evaluated by your debt to income. That determines your ability to repay the loan. It determines how much of a loan you can take on. A very good debt to income ratio would be somewhere along the lines of 43% or lower. Keep in mind, it's not factoring in how much you spend on gas, how much you spend on electricity, groceries, and things along those lines. It is, however, going to evaluate any credit obligations you have. So if you have any questions on DTI, feel free to leave them in the comment section below. Down payment. I'm sure you've heard of it. If you bought a car or jewelry, you're probably familiar with putting money down to gain any sort of equity or ownership. A down payment is just a lump sum of money you put down when you're purchasing a home. So, a good down payment, which would make you a less riskier buyer or borrower, is 20% or more down. It's not always a requirement, but that is what banks and lenders look to see if you're a less riskier buyer. Keep in mind, the amount you put down is the amount of ownership you have in the home. That's your equity. Ownership is equity. So the more you put down, the more ownership you have. That also will show the banks that you're not as risky if you're putting 20% or more. If you're putting less down, then you will appear more risky to banks, which can give you some less favorable terms when it comes to borrowing a home loan, getting your mortgage. Also, it can be less favorable if down the road you are looking to refinance your home. You may get less favorable terms or be unable to do it because you don't have as much equity, you don't have as much ownership in the home. So a down payment is very key and very critical part. That would fall under the properties part of buying a home. Remember again, income, property, assets, and credit. How much ownership do you have in the property? That part is very critical as well to purchasing a home. But simply put, a down payment is a lump sum that you put towards the ownership stake in your home. All right, earnest money deposit. Not to be confused with a down payment. An earnest money deposit is a small amount of funds that you give to the seller to show that you're committed to buying the home. So Many may or may not know, but sellers don't always sell the home on the first try. Sometimes they can go through that process two, three, four plus times, just based on mortgage borrowers not being able to get the loan approved. So imagine going through that process over and over again and not being able to sell the home, and you need to sell the home. So what sellers do implement is an earnest money deposit. That is a commitment. That's a promise that you are moving forward with the loan. Some can be non-refundable, some can be refundable. I know in today's society of mortgages, most of them are non-refundable because sellers do not want to lose out. They want to make sure you're committed. They want to make sure that you have some skin in the game. So what they do is set aside an earnest money deposit that'll be placed in an account. Upon closing, that deposit will be applied towards your down payment or out-of-pocket expenses to close the mortgage transaction. Simple enough, earnest money deposit. But it's not a down payment, it is a deposit. That's your commitment to the seller. Escrow account. An escrow account is a special account that's set aside to pay your property taxes and homeowners insurance. It is included with your monthly mortgage payment. So the escrow account can go up or down. The bank or mortgage company is not responsible for that. They break it down monthly based on whatever your homeowner's insurance amount is when it's due, based on whatever your property taxes amount is on its due date. And they set it in an account. The mortgage company or bank will pay your property taxes on your behalf. They just collect that each month with your mortgage payment. So some I've had folks say, "Hey, my mortgage payment went up. What happened?" I look at it. I see their mortgage statement. There's been a change in the property taxes. It increased. Or there's been a change in their homeowner's insurance. It's increased. That is something that's out of the bank's control. Again, if you have a conventional loan, you may be able to waive your property taxes and homeowner's insurance account, otherwise known as an escrow. You may hear in some states and counties as an impound account. That's just an escrow account. It's a special account set aside to pay your property taxes and homeowners insurance. It's always required if you get a government loan. So if you get an FHA loan, VA loan, USDA loan, you are required to have an escrow account to pay your property taxes and homeowners insurance. Equity. We've gone over it a few times, but equity is your ownership stake in the home. It's the part of the home that you own. You can gain equity through your down payment. You can also gain equity through the value of your home increasing, which, of course, that would be determined by an appraisal. However, equity is the part of the home that you own. So if you have a loan on your house for 200,000 and your home is valued, it's worth 300,000. You have $100,000 of equity in that home. Some people will use their equity to cash out on it and use it for other investment purposes. They may use it to renovate the home, add a garage, add a pool. But equity is the amount of the home that you own. And again, the more you put on your down payment, the more ownership you have in the home. The less you put down, the less equity you have or ownership you have of the home. Simply put, it's the part of the house that you own. Fannie Mae. I know some of you have heard it. I know some that I've done applications for and closings for think that Fannie Mae is a government agency, but it's not. It's a government sponsored company that buys loans from the banks or lenders on the secondary market. So when you get a mortgage and it's sponsored by Fannie Mae, they have to conform to the loan guidelines by Fannie Mae. Fannie Mae will buy the loan from the bank, which the bank will use the proceeds to lend out more mortgages to other borrowers. It's not a government agency, it's a government sponsored company that sets the regulations and terms that your bank must follow in order for them to buy the loan on the secondary market. They're not buying the loan and you're going to pay make your payments to Fannie Mae. I know some people say, "Oh, the bank sold my mortgage." The bank will sell it to Fannie Mae, Freddie Mac, FHA, VA, USDA. However, this is something that's done behind the scenes in order to allow the bank to lend more money to borrowers. Fannie Mae is not a government agency, but they are sponsored by the government. FHA, Federal Housing Administration. An FHA loan is a loan from the Federal Housing Administration. It's backed by the government. This is a government backed loan. This is through the government. FHA is to help make things easier for people to buy a house. Some of the benefits are lower down payment requirements. FHA will allow you to put as low as 3.5% down. FHA can allow credit scores in the 500 and still get a loan. FHA has a lot of flexible options because the goal is to promote Americans buying more homes, and FHA allows that. Now, some of the unfavorable terms is it does come with special insurance called PMI, private mortgage insurance. You have to pay that in addition to your homeowner's insurance, property taxes, and principal and interest payments. However, the FHA loans do come with benefits such as low down payment. It'll allow a higher loan to value ratio. It allows a higher debt to income ratio than a conventional or some of your more traditional options. So, simply put, FHA is a government backed loan. The guidelines are set by the government to protect you as a consumer, and there is flexibility to allow you as a consumer to purchase a home that you may not be able to get through a conventional loan, where some banks will require a 20% down payment. FHA will require a 3.5% down. This is a great startup loan for any first time home buyers that may not have as much money set aside to pay out of pocket expenses. Also, a benefit with FHA is you can have the seller pay up to 6% on your closing costs. So if you're buying a home at 300,000, you are able to have the seller pay 6% of that $300,000 home purchase towards your closing costs, where some conventional loans can be 3% or less. So there are a lot of benefits, but keep in mind FHA is a government backed loan. The regulations are set by the government, not by the banker lender. The banker lender is not in control over that. FHA is. That's the Federal Housing Administration.